Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Friday, 3rd October. Coming up on the show, Wall Street hits record highs even as the government shutdown drags on. AI tie-ups involving OpenAI and Nvidia fuel investor enthusiasm. And I'll tell you all about something called the debasement trade. So grab your coffee and let's own the morning. Well, the first thing you need to know about is that Wall Street hit record highs on Thursday and that the rally looks set to continue today. Wall Street seems to have shrugged off the ongoing shutdown as it drags into its third day. Stocks on Thursday rose as enthusiasm for AI continued. OpenAI's $500 billion valuation, making the company the most valuable startup in the world, certainly helped. Now, the tech-heavy Nasdaq Composite, the S&P 500 and the Dow Jones Industrial all hit new records. Okay, the next thing you need to know is that the president is weighing up slashing thousands of federal jobs ahead of a meeting with his budget director, Russell Vought. This move is seen as piling on more pressure on Democrats to end the government shutdown. Now, normally today, Wall Street would be on edge for the release of the September jobs report. However, the government shutdown is all but certain to delay the release of the data, leaving Wall Street in the dark. And the final thing you need to know about is all about AI and some major tie-ups. Japan's Hitachi and OpenAI have announced a strategic partnership. They'll be teaming up on energy projects. This sends Hitachi shares up around 10%. And another AI deal could be days away. According to Bloomberg, Global Infrastructure Partners is in advanced talks to acquire aligned data centers in a deal thought to be worth $40 billion. Now, some investors are in wait-and-see mode as the government shutdown grinds on. And with that, the odds of a rate cut at the Fed's next meeting have jumped since last week. Kathy Jones, Charles Schwab chief fixed income strategist, sat down with Ali Kanal on Market Catalysts and took a closer look at the state of the labour market, the shutdown, and what that means for the Fed.
We have an economy that's running on two tracks with, wealthier people with higher incomes doing fine and continuing to spend. And in aggregate, that's keeping the economy growing, like consumption. On the other hand, you have a lot of softness in the labor market, particularly for younger workers or for people who traditionally have had a harder time finding employment. So you've got two different tracks going here. And the consumption level is holding up GDP growth, but the weakness in the labor market could lead to, a significant downturn the longer this goes on. And not the least of which is if the administration succeeds in firing a bunch of federal workers, that's going to send the labor market into even more of a downturn. So Fed has to watch these numbers. They take a number of surveys. Every Federal Reserve Bank has surveys monthly in their district. They're going to pay a lot of attention to those numbers because that's data that they can gather and that's their constituents. So we're just going to keep an eye on this. My bet is that they do cut rates another time in the fourth quarter, maybe twice. But that inflation data, inflation pressure just doesn't look like it's going to ebb anytime soon.
Yeah, and I've been having that conversation with a lot of folks out there that inflation, it's really not going in the right direction at this point. We're still significantly above the Fed's 2% target. And some have told me that markets may be accepting the fact that we are just in this 3% range higher for longer. Do you think bond traders believe that as well?
Well, I think that's what's being priced in, but I'm not naive enough to think that the Fed is just going to say, okay, we'll take 3%. I just don't think that that's something that they are willing to do. They basically have to change their mandate. So if you're betting on the Fed just throwing up its hands and saying, well, we can live with 3%, I think you're making the wrong bet. You're betting on too many rate cuts in this cycle. My guess is that the Fed is serious about getting inflation down to 2%, will accept some rise in the unemployment rate if they see that as creating enough slack to get the inflation figures to come down.
Okay, the AI trade is providing support for markets this week and helping drive markets to record highs on Thursday. Now, OpenAI securing the title as the world's most valuable startup after its latest share sale. The company now worth $500 billion, which is above Elon Musk's SpaceX. Well, when you look at the top private companies on Yahoo Finance, you'll notice one trend: AI. Among the other most valuable companies, Anthropic, Databricks and Stripe round out the top 5. Well, Nancy Tengler, Laffer Tengler Investments CEO and CIO, weighed in on the eye-popping valuation for OpenAI and suggested 2 other private companies to watch as investment opportunities.
And there's been a lot of buzz around private markets after that $500 billion OpenAI valuation. Is private AI exposure something you've ever considered, or would you prefer to stick with those public names that have a bit more liquidity and you more disclosure as well?
Well, shout out to EquityZen. They've got a great model where you can go into their fund and they own actual shares in these private companies that, and the liquidity is, it provides liquidity for some of the insiders, which is a pretty cool concept. Think if you're in a company that takes 10 years to go public, it's great if your valuation, the stock valuation has quadrupled, but if you can't realize any of that benefit, it's not so good. So it's a win-win for the insiders and a win-win for private investors. We are in the process of starting our own fund through EquityZen in order to be able to offer those shares to our clients. And the names I'm excited about are XAI and SpaceX, and of course OpenAI. But it's a new area, and I think it's matured enough that retail investors can get in.
Yeah, exciting time for a lot of investors right now. Nancy, thank you so much. Appreciate your insights as always.
Okay, some news overnight from the West Coast and a large fire breaking out at a Chevron refinery in California. The fire starting after an explosion at the jet fuel production unit of the refinery just south of Los Angeles. It's situated near LAX airport. It's one of the largest refineries on the West Coast. It's unclear what triggered the blast, but local residents said it felt like an earthquake. Now, according to Chevron's website, the refinery is capable of refining 290,000 barrels of crude oil per day, and its primary products are gasoline, jet and diesel fuel. Now, emergency crews containing part of the fire overnight, and Chevron says all personnel and contractors have been accounted for and there are no injuries. Well, the news of the fire is having little effect on Chevron shares ahead of the opening bell, as you can see there. Now, the fire will likely not affect oil prices, but it could drive gasoline prices higher in California, which already has the highest prices in the country. Let's get a quick check on the broader energy markets now. And oil prices are rebounding this morning after hitting 4-month lows on Thursday. For the week, crude prices are on track for their biggest weekly decline since late June. Brent is down roughly 8% this week. Fears of oversupply are weighing on oil, especially with an OPEC Plus meeting looming on Sunday. The group will decide on output for November, and it's possible OPEC Plus could discuss fast-tracking supply hikes. Okay, coming up on Morning Brief Market Sunrise, what you need to know about the data blackout thanks to the government shutdown. Jared Blickery has a deep dive on the information you can track to help you make investment decisions. Plus, our call of the day, JPMorgan has a closer look at the relationship between gold and Bitcoin. Stay tuned. Welcome back to Morning Brief Market Sunrise. We're looking at modest gains when the markets open in the US. While today is the first Friday of the month, investors won't be getting the government's monthly jobs report thanks to the shutdown. But it doesn't mean investors have to fly blind. Jared Blickery has a closer look at other data you can track.
The fourth quarter is upon us, and October has a volatile reputation in the markets, which it has earned. It's where the pressure tends to build and where it often releases in many years, letting the market sail into a year-end soft-bedded Santa Claus rally if history repeats itself. Today in Stocks and Translation, we are breaking down the volatile seasonal tendencies of this storied fourth quarter. And let's start with the beginning with a definition of a market crash. It isn't just a bad day. It is a sudden, steep drop that vaporizes value in days or weeks, often fueled by panic and forced unwinds. That's when selling itself causes more selling. And although we've seen market crashes in just about every month of the year going back a century, for some reason, some of the big ones have clustered in the second half of the month of October. Now let's take a look at some of them. Nearly 40 years ago in 1987, so-called Black Monday on October 19th became the template for modern panic, as the Dow crashed over 20% in one day. But on October 24th, 1929, nearly a century ago, Black Monday kicked off the bear market that marked the beginning of the Great Depression. Also on the 24th, but in 2008 this time, after the fall of Lehman Brothers amid the global financial crisis, the VIX Volatility Index hit an eye-watering 89.53, an all-time high that survives to this day. Then on October 27th in 1997, we had a mini crash which triggered the first market-wide circuit breakers in the modern era, which were put into place after that 87 crash. The good news is not every year has these cataclysmic events. So let's take a look at what's happened quarter by quarter in the S&P 500 since 1990, something we call seasonality and like to talk a lot about here. What jumps out is the outsized median return in Q4 to the right of your screen, 6.5%, which tends to be positive over 80% of the time. Compare that to the first 3 quarters of the year, which tend to see returns of less than half of that in the 2% range, with only about 2 and 3 years being positive. And even when October spikes lower, November and December tend to grind higher historically. In this chart here, we've sliced and diced the data a little bit differently. We're only looking at the first year of each president's 4-year term going all the way back to 1949, which has happened 19 times. Here, Q4 is still the best with a median return of 5.5% and a win percentage that's near 80%, pretty close to the prior map. You can also see how returns tend to get better each quarter as the year progresses. Now let's take a look at what typically happens in the VIX Volatility Index each year. That's in white versus what's already happened in 2025, which is in green. Notice how the white line climbs higher in August, September, and October, then it peaks and falls into year-end. That lower year-end volatility is what typically supports predictable December gains and the so-called Santa Claus rally at the end of the month. But I should point out that in 2018, we had a near bear market in December, which had the worst return since 1931. Guess what? That was also when we had the last government shutdown. But as we showed earlier in the week, shutdowns don't tend to rattle stocks too much. They're more of a bond market mover. So what should investors be watching right now? Let's start with that economic data, assuming it's even released on time. The monthly jobs numbers are scheduled for Friday, October 3rd, while CPI inflation is set for Wednesday, October 15th. But watch out for shutdown-related delays. There's also a Fed meeting at month end, but that shouldn't be affected by government closures. Then earnings season will set the tone when it kicks off in mid-October with the big banks. Listen for margins, investment forecasts for 2026, and how the AI spend is progressing. Then, as earnings season matures, the corporate buyback window reopens, a topic we recently covered here on Stocks in Translation. After companies report earnings, they can buy back their stock again, which supports the markets. And speaking of markets, watch the dollar and bonds. That's where trouble usually shows up first. Big movements sometimes spill over into stocks. Bottom line, October may bring the thunder, but history says that the sun usually breaks through before year's end. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Coming up on Morning Brief Market Sunrise, trouble brewing for Japan's Asahi Group. The details on how a cyber attack could affect Japan's beer supply. That's next on Market Sunrise. Plus, JPMorgan's big call on Bitcoin. The bank sees significant upside ahead and also weighs in on the cryptocurrency relationship to gold. It's time now for today's trending tickers. Nvidia striking another deal this morning, this time with Japanese telecom and computer giant Fujitsu. The companies will work together on AI to make smart robots and other innovations using Nvidia's computer chips. The hope is to establish the AI infrastructure for Japan by 2030. Nvidia CEO Jensen Huang taking the stage overnight saying, quote, "Building the infrastructure to power it is essential in Japan and around the world." Shares of Fujitsu closing higher by 3% overnight and ahead of the opening bell on Wall Street. Nvidia shares catching a bit of a bid too, poised to open higher as well. But there is trouble brewing for Japan and its beer supply. Asahi Group is under pressure this week after a cyber attack crippled production operations on Monday. Bars and restaurants in Japan are already reporting they are running out of Asahi products. A report in the Financial Times Thursday saying that Asahi's super dry supply could dry up in 2 or 3 days. Now, Asahi is working to restore its computer system, but the company says it is unclear how soon the company can resume full operations. Computers are still down, but the company has started processing some orders by visiting customers in person and handwriting orders. Now, Asahi says it's looking into the effect the attack will have on earnings. We're also watching shares of Palantir this morning. The stock right now is little changed, but a new report says the company's battlefield communication software that it built with Anduril and others has major flaws. Reuters is citing an internal army memo which says it has fundamental security problems and should be treated as a very high risk. This coming months after Anduril was awarded a $100 million contract to create the prototype for the platform with other companies, including Palantir and Microsoft. Neither Palantir nor Anduril provided a comment to Reuters. Finally, checking in on shares of Tesla. The stock bouncing back after selling off on Thursday. The EV maker reported a 29% gain in third quarter deliveries, which was much higher than Wall Street expected. And CEO Elon Musk's controversial $1 trillion pay package coming under scrutiny from a group of shareholders. New York City Comptroller Brad Lander signing the letter, and he calls on investors to reject the proposal and oppose re-election of the company's board. The Tesla delivery numbers a surprise to Wall Street. Well, here's what one analyst told Miles Udland on market domination.
I'm curious how you thought about those delivery numbers and how it really sets up the company into a year where I think you're looking for them to inflect back to growth on the vehicle side of the business.
Well, it's really important because, as I'm sure you remember, over the last 6 to 9 months, it's been pretty difficult for Tesla. They saw year-over-year declines in revenue and deliveries. And so this was a pivotal moment. They've proven to themselves, to Wall Street, that they actually can grow the company again. And it was super important to see that inflection point in deliveries. But the question now is whether that momentum can continue into Q4 into 2026, particularly as some of the EV incentives in the U.S. rolled off a couple days ago. And we think that will happen likely because of new vehicle introductions. They've promised a couple to us, at least one, over the next couple few months. And we think we'll see them, and that should sustain some of the momentum that we saw in the third quarter.
Yeah, George, I'm curious the extent to which you think that incentive expiring at the end of the third quarter pulled forward demand, if that, like how much that factors into the number that we saw and how you think about that in terms of what's the normalized level, let's say, of demand for Teslas going forward from here.
That's a great question. I mean, I think it's fair to say that it probably did. There are people sort of lining up. The inventories came down. They sold more than they produced in the quarter. So that would imply to us that there was definitely some pull forward. What we have modeled in the fourth quarter is that we'll see a sequential decline, which goes against what they normally see. More people buy cars in the fourth quarter than the third quarter. And that's okay. I mean, I think most people expect that. The real question mark is, can they grow the company? Can they grow revenues in 2026 and beyond? And we think it's, like I said, it's likely because they'll have new vehicles that introduce, probably create some excitement on Wall Street and from consumers. So we expect that to happen. What's really important as well is that if you look at what's happening in the EV marketplace, there's a lot of concern from some of the traditional OEMs around EV demand in 2026, and we get it because of those EV incentives. But to the extent those companies are pulling back on their offerings, it creates an opportunity for Tesla to sell more EVs.
All right, JPMorgan has predicted that Bitcoin could hit $165,000 by the end of the year. That's around 40% higher than where it currently trades. Why? Well, they've coined the term the debasement trade. This is when investors, and in particular retail ones, flock to Bitcoin and gold as hedges against deficits, inflation, and weakening traditional currencies. And the dollar certainly has been. Now, basically, the rising popularity of Bitcoin and gold reflects deeper economic anxieties. Well, since late 2024, retail investors have been pouring into both Bitcoin and gold ETFs. As you can see, Bitcoin trades just at around $120,000 right now, up over 1% today. But over the course of the year, it's still lagging behind gold's performance, as you can see here. Now, JPMorgan's prediction is based on a calculation that reflects the amount of capital needed to hold Bitcoin versus gold and comes at a time when demand for both assets is surging. In the bank's report, it highlights how this valuation gap has shifted. At the end of 2024, Bitcoin, it says, was considered $36,000 overvalued compared to gold. Today, it's roughly $46,000 undervalued, creating a strong case for upside. Now, gold prices today are fairly steady, but they're heading for their 7th consecutive weekly rise. JPMorgan says that this stronger demand for safe haven assets like gold and the fact more retail investors are getting involved has pushed them to revise their call on Bitcoin higher. And they're not the only ones. Some have even projected $200,000 by year end. Okay, before we go, let's check in on the markets. We start with Asia, and Asian markets seem to take their cues from Wall Street overnight. Tech stocks rising here over investor enthusiasm for all things AI. The Nikkei Japan is close to an all-time record high again. Remember, this weekend there will be a crucial vote that will determine the country's next prime minister and set the tone for future monetary and fiscal policy. Okay, let's turn it over to Europe now, and the rally in the region is showing no signs of easing in general. The FTSE 100 hitting another record high there. Mining stocks are leading the way there, and obviously the FTSE has mining stocks in it. In fact, copper is actually heading for its biggest weekly gain since April. And the FTSE also climbing despite data out today that showed business activity in the UK grew at its slowest pace in 5 months during September. All right, let's check in on Wall Street one final time now. And it looks like the markets will continue that rally. Everything looking pretty positive before the opening bell. And it's, again, those AI tie-ups that are giving investors more confidence in the tech-fueled rally. As you can see there, all the Dow up over 80 points, S&P up over 10 points, and the Nasdaq due to open up around 40 points. So all looking pretty positive before we head to the opening bell on Wall Street. Okay, that is it for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. Coming up next, join Julie Hyman ahead of the market open on Morning Brief. I'm Ramzan Karmali. Go own the morning.